Okay, this is the second video for the comprehensive problem of 36B. We will be working number 2, which is the profitability analysis. So there are several factors that we look at for requirement 2 in the profitability analysis. The first one that we look at is what we call the profit margin ratio. What this is we look at the net income compared to the net sales revenue. So this is what we want this as a percentage. So what I've done is I have filled in for 2014 through 2018 the dollar amounts of net income, and then I've also filled in the net sales revenue. Remember, these numbers are given. You just have to take these off of the problem. Then you figure out the profit margin ratio, which I've set up here. It is the percentage of net income to net sales revenue. So if we look at that, let's go ahead and start with 2014 and work our way up. So you do net income divided by net sales revenue, and we want this to be a percentage. And as you can see here, this is 2%. I want it to be more detailed, so I want my percentages to be a little bit more precise. You can round it to the tenths. That will be fine. So let's do the next one. We'll leave it as 4%. So as you can see here is our profit margin ratio is increasing, meaning that we have more left in the bottom line when compared to your net sales revenue, which we'll talk about in a second. Let's just go ahead and get all of our numbers in. Let's see, 4.8%, and then we'll just do these. Make sure you put your equal sign if you're wanting to do the Excel formula. So let's just format these together and make it a little bit quicker. Okay, so as we can see, it's increasing over time here. All right, now let's look at our rate of return on total assets. This is another profitability analysis that we do. So we do profit margin ratio, rate of return on total assets. This is where you take your net income plus your interest and divide it by your average total assets. Well, in this situation here, we do not have to calculate this. This is given in the data, so you can see here our numbers and what they're doing. They're going up. So let's move on to the asset turnover ratio. And what this is this is the net sales revenue divided by your average total assets, okay? So what you have to do is you have to fill in your net sales revenue, which we have here, and then you have to do your average total assets. To get your average total assets, you take this year's balance and you take last year's balance, which would be the beginning balance, and then the ending balance is this year's. And what you do is you average those. So that is why we did not include 2014, because we do not have 2013's information. So this is how we got these numbers. If you look back on your financial summary, if you look in 2015 and you find total assets, you will see that I believe this is supposed to be 78. But if you look at 2014, it was 64,000. So that's your beginning. And then at the end of 2015, you had 78,700. So what we have to do is we have to get an average of the two numbers. So 64,000 and 78,700. I believe. Let me make sure that's right. So if we add these together, we want to get a sum of these two numbers, but then after we sum it, we want to divide it by 2. Basically add it up and divide by 2 and get us an average. So you end up with 71,350. Now I'm going to check over here and make sure that my numbers, let's see, 78,700 and 64,000. So I believe there's a error in my key, but we'll just keep moving from here. So we would do the same thing with these. We would add them up, because anytime you get an average, you add the numbers up, and if it's just 2 of them, you divide by 2. So here we would get 84,300. And then here we could probably use this average function if you wanted to. 92. Yes, that's another way. There's lots of ways to work these in Excel. Excel has a lot of formulas you can use. So 101,500. So I need to edit these to have my dollar signs. And these are our average total assets for each year. And then once we get our average total assets, first we have to do that. Then once we get that number, we're going to take our net sales revenue, and I'll start back here. We're going to take our net sales revenue and divide it by our average total assets. And what we want to do here is we want to round this. Let's round this to the hundredths. Will be fine. So 2.36, and then here we would do net sales revenue divided by average total assets and net sales revenue divided by average total assets. So when you're doing your problems, you're using your formulas to get your numbers, but a lot of this is given to you and you only have a few calculations to make, okay? Then we need to do the rate of return, and we really didn't need this right here, so I'll just delete that. The rate of return on common stockholders' equity. So this is given to us in the data, and I did not put this in, so I'm going to go ahead and just copy this over. For some reason I forgot to put that in there. So $1.10 and 0.80 cents. And the main mistake you can make here is just copying numbers over wrong. So once you get your numbers in, go back and check over it and just make sure that you're entering in what's given to you correctly, because that can be the biggest mistake when you're in accounting, is just copying wrong. And then you can see our earnings per share is how much we make on each common share we have. So let's look at our analysis. Let's think about this for a second. Look at all the profitability analysis. We have to, when we're doing profitability analysis, we need to look at everything. So we can say here that the profit margin ratio, return on assets, asset turnover ratio, and the return on equity are increasing over the 5 years examined. Okay, and we can also say here that the return on equity, the return on assets, and the return on equity are respectable. And we can say the earnings per share is increasing over time so that the stock is attractive. I mean, if I'm buying stock, I want to see positive things happening. I want to see it going up. I want a trend of it increasing. Or if I see it's decreasing and I'm thinking about buying stock, I may not want to purchase that stock. If the trend is it's decreasing, I probably wouldn't purchase it. But look in your book and make sure when you're going through these different measures, what's good, what's not good, do I want it to increase? And of course in these we do. So just make sure that you use your PowerPoint and your book to kind of guide you, because these are a lot of different measures here and it's hard to keep up with. So make sure you read about each one and understand what's going on here, okay? And that is all for requirement